Have you ever wondered how to pick dividend stocks, or why they're such a big deal in the first place? Well, they're more than just another notch on Wall Street's belt. Dividend stocks form a crucial piece of any savvy investor's portfolio puzzle. Imagine owning a piece of a company that not only appreciates in value but also regularly pays you a share of its profits. That's the allure of dividend stocks. They provide investors with a double whammy of potential capital appreciation and the sweet promise of passive income generation. These dividends, which are typically paid out quarterly, can be a consistent source of income that's independent of market fluctuations. Over the long term, they can significantly contribute to wealth accumulation, especially when reinvested. In a world where financial security is often a mirage, dividend stocks offer an oasis of stability. Clearly, dividend stocks can be quite the game changer for your investment portfolio, but what exactly are they? Dividend stocks, quite simply, are shares in companies that pay out dividends to shareholders. Now you may be wondering, what exactly are dividends? Well, dividends are a portion of a company's that are distributed to shareholders, typically on a quarterly basis. This is a way for companies to share their financial success with the people who have invested in them. Contrast this with companies that don't pay dividends, where the assumed value for shareholders comes solely from the potential rise in the company's stock price. But with dividend stocks, you're getting a two-for-one deal: the potential for stock price appreciation and the added bonus of regular income from dividends. Do companies choose to pay dividends? Well, there are several reasons. It could be to attract investors, to distribute excess cash, or to signal financial health. So now that we know what dividend stocks are, let's delve into the perks of investing in them. If you found this information helpful, make sure to hit that like button. Don't forget to subscribe to our channel for more insightful financial information. Also, check out our recommended video to dive deeper into the world of dividend stocks. Your financial future thanks you. Investing in dividend stocks comes with a host of benefits. One of the most attractive perks is stability. Unlike growth stocks, which can be volatile, dividend stocks typically belong to established companies with steady earnings. This means they can be a safer harbor in stormy market conditions. Another advantage is the consistent income they provide. When a company makes a profit, it can choose to share a portion of this with its shareholders in the form of dividends. This can be a reliable source of cash flow, independent of the stock's price fluctuations. But perhaps the most compelling benefit of dividend investing is the potential for capital appreciation. When you reinvest your dividends, you're buying more shares of the company. Over time, this can lead to exponential growth, as your dividends earn dividends of their own. It's the magic of compounding at work. Impressive, right? But how do you pick the right dividend stocks? Choosing the right dividend stocks involves careful analysis of key financial metrics. Let's dive into some of these essential ratios and metrics. First up is dividend yield. It's a simple ratio that shows you how much a company pays out in dividends each year relative to its stock price. To calculate it, you divide the annual dividends per share by the price per share. A higher yield can be attractive, but remember, a yield that seems too good to be true might be a red flag. Next, we have the dividend payout ratio. This measures the proportion of earnings a company pays to its shareholders in the form of dividends. It's calculated by dividing the annual dividends per share by the earnings per share. A lower payout ratio could mean the company has room to increase its dividends in the future. Moving on to the dividend growth rate. This shows how much a company's dividend has grown over a specific period. It can be a good sign of a company's financial health and its commitment to returning profits to shareholders. You can calculate it by taking the dividend per share at the end of the period, subtracting the dividend per share at the start of the period, and then dividing by the dividend per share at the start of the period. Next on our list is earnings per share, or EPS. This measures a company's profitability. It's calculated by subtracting dividends on preferred stock from net income and then dividing by the average outstanding shares. A higher EPS can indicate a company's ability to pay dividends. Finally, we have the price-to-earnings ratio, or PE ratio. It's a valuation ratio calculated by dividing the market value per share by the earnings per share. A lower PE ratio could indicate that the stock is undervalued, but it's essential to compare it with other companies in the same industry. Remember, these metrics are just tools to help you in your analysis. They should not be used in isolation, but rather as part of a broader evaluation of a company's financial health and performance. But it's not just about the numbers. You also need to assess the sustainability of the dividends. A crucial part of picking dividend stocks is gauging whether the company can keep paying dividends. Let's break this down. First, we have company fundamentals. Think of this as the company's health check. Are their profits steady? Is their debt manageable? These are the sort of questions you should be asking. Next up is cash flow. A company might look profitable on paper, but if it's not generating enough cash, it might struggle to pay dividends. So, always keep an eye on the cash flow. We also need to consider industry trends. Is the company's industry growing or shrinking? A shrinking industry might mean lower profits in the future, which could impact dividend payments. So, how do you assess a company's ability to maintain or grow its dividend payments? Look for companies with strong fundamentals, healthy cash flows, and a position in a growing industry. So, you've picked your stocks and assessed their sustainability. But remember, never put all your eggs in one basket. Diversification is key to a healthy dividend portfolio. This saying holds true for all forms of investing, but it's especially critical when it comes to dividend stocks. Why? Because a well-diversified portfolio can help you weather the inevitable storms that come with investing. Let's break it down. Diversification is the practice of spreading your investments across different sectors and industries. This is like not putting all your eggs in one basket. If one sector faces a downturn, your other investments can help offset the loss. For instance, if you're invested in both technology and healthcare stocks, and the tech sector takes a hit, your healthcare investments can potentially soften the blow. Moreover, diversification isn't just about sectors and industries, it's also about the size of the companies you're investing in. Consider spreading your investments across large-cap, mid-cap, and small-cap stocks. This can help ensure that you're not overly exposed to the risks associated with any one segment of the market. Now let's talk about risk management. Risk is an inherent part of investing. However, there are strategies you can use to mitigate these risks. One of these strategies is to keep a close eye on your dividend yield. A high yield can be enticing, but it can also be a red flag. Often it indicates that the stock's price has fallen, which may suggest the company is in trouble. Another strategy is to watch for dividend cuts. If a company you're invested in slashes its dividend, it's usually a sign of financial distress. In such cases, it may be wise to reassess your investment. Finally, consider setting stop-loss orders. These are designed to limit an investor's loss on a position in a security. By setting a stop-loss order, you're telling your broker to sell the stock when it reaches a certain price. This can help protect your portfolio from major losses. Now, equipped with this knowledge, you're ready to dive into the world of dividend investing. So go ahead, start exploring, and remember, knowledge is the best investment you can make.